Today, we are going to take a look at the 3 layers of risks that come along with investments and also how to reduce those risks. Hello and welcome. My name is Peter B. and I welcome you here at My First Million, where we are achieving our financial goals together. So, there are 3 layers of risks. Why I'm calling them layers? Because they're stacked one on top of the other. So even though you reduce maybe one layer, there may be still other layers of risk also to take into consideration. So we are going now next to take a look at those 3 layers. What are those 3 layers? And especially we are also going then to take a look at what we can exactly do to reduce the risks whenever we are doing investments. So for this, let me share my beautiful whiteboard. So let me switch over. So the first layer of risk. The first layer of risk is related to the investment itself. And there are basically 2 kinds of risk related to investments. There's the systematic risk and the unsystematic risk. The systematic risk is basically the risks that you encounter in the whole market, whereas the unsystematic risk is the risk specific to an investment. So I want to give some examples of systematic and unsystematic risks. So let's take a look at, for instance, the stock market. The systematic risk is maybe the whole cycle that the whole stock market is going through. There are like a boom periods and there are like a bust periods where everything might be declining, or like the bear market coming up, maybe during a recession or before a recession. So these are the cycles that the whole market are coming through. What could be these kind of risks? For instance, like inflation. If inflation is hitting the company's cost structures, this is a systematic sort of risks, which affects the whole market, not just one specific company. Another kind of risk could be, for instance, if the tax rates are changing, so that the company need to pay more or less taxes. This also usually involves the whole stock market. Then, for instance, taking a look at the real estate market, there are also systematic risks there. For instance, it could be that the interest rate is rising and therefore all the mortgage rates is going up. So it's getting more and more difficult to afford real estate. Or another possibility could be that there were some extreme events like a hurricane were hitting maybe a country, and as a result of this, after the hurricane hit the country, all the insurances are increasing their prices. So the whole market is affected of the influence of those upcoming risks. So these are the systematic risks. We call them systematic risk. In contrast, the unsystematic risks are those not related directly to the system, but to one specific investment opportunity. For instance, for a company, it could be that maybe management could be doing fraud. So if the management of a specific company is doing fraud, this is more of an unsystematic risk specific to a company. Or maybe a company is launching a new product, but maybe the new product is not well received in the market and the sales are crashing down or declining based on that not successful product launch. So if this is also one sort of systematic risk related to the company directly. And maybe in other investments, of course, also have unsystematic risk. For instance, if you are investing into bonds may be corporate bonds where you are giving money to the company who will then invest this money and give you interest back as a rate of return. Maybe suddenly the company will need to declare bankruptcy. In that cases, maybe you will not get your principal of your bond investment back anymore, and as a result, you will lose the money. So this is also one kind of unsystematic risk. Then let's say, for instance, again, real estate again. What's an example of real estate? Of real estate related unsystematic risk. Maybe you buy one rental property and you rent it out to a person. but this person maybe doesn't take care of your rental property. Maybe even worse, he will damage everything. And maybe even worse, after a while he'll stop paying rent. And when you finally get toward him to get your rent payments back, he maybe will suddenly run away without paying any rent. So this kind of risks are unsystematic risk, specific to the investment that you have been doing. So this is the first layer of risk, the systematic risks and the unsystematic risks, which are directly related to the investment. So let's take a look at the second layer then. The second layer of risk is related to the investor's knowledge. So basically, there are two kinds of risk that fall into this category. The first, there's the white space. These are all the things related to the investment that you don't know. And secondly, there's the false knowledge. False knowledge are things that you believe to know or to already know and research, but aren't necessarily true. So again, there are maybe several examples that we can take a look at. First, at the white space. If you just start out as an investor, maybe you have heard of investing, but you have no idea where to start. So you basically start with a blank sheet of paper, which is completely white. Then you start maybe to learn of the different investment opportunities. You will learn, there's a stock market, there's a bond market, there are real estates, also as opportunity for investments, and there are many other kind of investment opportunities out there. So slowly over time, your white paper will is getting filled in with color, and the color is presenting all the knowledge that you're acquiring. And then of course over time you are learning more and more, not just about investing in general, but also how to do investments or about specific investment opportunities, and you learn how to analyze them, what risks are attached to them, how to analyze a good deal, how to find a good deal. Maybe you will learn about diversification. So over time, this blanket sheet will get more and more filled out, and there's less and less white space as you continue to learn. However, no matter how long you already are doing investing, you will always have some white space. There are always areas you don't know about. There are always areas that maybe you don't know well enough about. So this is the white space risk of your knowledge. Then also there is maybe false knowledge that you pick up. Maybe you hear something from a channel, like a YouTube channel, or you read an article, or you do a research on a company, and you have some impressions of the company that you believe to be true. But actually maybe this information that you're learning is wrong, or this information that you were picking up is not true. So in these situations, it's false knowledge what you pick up. So maybe an example could be you believe a company has an excellent management team. They are very professional in communicating, they do a good work, until maybe one cyclical cycle is hitting the company and everything falls apart. And then you realize, oh, actually the company's management team wasn't that good in the first place. I was evaluating their management team wrong. So this is the second area. Then let's take a look at the last layer of risks. Last layer of risk again is related to the investor, but this time on the investor's behavior. Especially when in situations that it can be that an investor, instead of acting rational, he will act emotional. And usually if emotional are attached to investments, the investments won't be very successful. So what kind of examples can you think of when it comes to this layer of risks of the investor's behavior? At least I can think of two. When the market is going up and a lot of investors are making very good and big gains, very often what will happen, there's a FOMO effect kicking in. FOMO is meaning fear of missing out. So more and more people feel like, oh, a lot of people are making money in the stock market or real estate market, and I also want to profit from this upward cycle. So this is often an emotional response, not a rational response, because maybe then your buying decision is just based on you don't want to miss out, rather than on true valuations of the investments that you are going to consider. Then on the opposite side, when the market is crashing down again, there's also very often a general emotional reaction that kicks in to many investors who don't have any controls in place, which is maybe they get maybe very scared and feel they are losing more and more of their money or even everything. So what often happens when the market is crashing at the low points or close to the low points, many people are selling out of their investments and trying to cash out again. But then they, of course, act anti-cyclical, which will lead to underperformance. So these are two examples of emotional risks in the market. So we have now the 3 layers of risks. So for all of the 3 layers, there are basically 3 things, again, that you can do in order to reduce the risks. First is for diversification. Diversification, or especially, is for the investment-related risks helpful. For the unsystematic and systematic risks that we take a look at before. So diversification will help you if you not just invest into one company, but into many companies. For example, through an ETF, or just through allocating your money to different companies. This will reduce this unsystematic risk of your investments. And if you also consider the time component here inside, so instead of putting everything into the market now, but having a long time horizon where you continue to invest, sometimes when the market is up and sometimes when the market is down, but you continue to invest. So this time diversification, where you allocate your investments over time, over a long period of time, is taking out the systematic risks from your investment approach. Then, especially for the second kind of risk, the lack of knowledge of the investor, is just to learn more, reduce the white space that you're having, but also at the same time verify everything that you have learned. Don't just hear something for one time, but make sure that what you learned is really true, or verify again whether what you learned, for instance, about a company, whether this is really true, or this is just someone's opinion or someone else's evaluation. So just continue to learn over and over again, and this will help you to reduce the risk of the layer where the investor has not enough knowledge to make an investment. Then for number 3, the behavioral risk of the investor, just try to set up some rules and try to stick to the rules of your system. This will reduce the risks from the 3rd layer. Set up the rules, make sure that you are investing along the rules. Of course, over time, you will learn more and more. And when you learn more, of course, maybe your rules will adjust over time. The more you learn, the better your rules are going to be. And you can verify, and the more experience you have, you can verify whether the rules are really working. So all those 3 areas all those 3 improvements are helping to reduce the risk that you will be never able to eliminate. But at least you can reduce them as much as possible. And in the end, everything that you're doing to reducing your risk will also reward you with a higher return. So going back to my whiteboard. So in the end, as mentioned before, there will always be some risks attached to investment. But the goal is to increase the probability for success, that what you're doing is going to be successful, and at the same time, the downside is somewhat protected, at least somehow protected, by decreasing risks with the actions that we mentioned before. To sum this up, do you have any experiences with risks that you already encountered in the market? Please, and that maybe I didn't cover so far in this video, please share your thoughts in the comments below so that we can learn from one another. Also, when it comes to investing, never forget rule number 1. Rule number 1 is telling us that you need to take ownership. You really need to take responsibility on whatever investing decision you're taking. You are the only one who can take control over your portfolio. And so therefore you need to learn more. But also don't go into an analysis paralysis. At one point you need to start out and overcome the fear. But instead of starting everything, maybe you can just pick one area of investing and get to a knowledge base where you feel comfortable that you can start to invest at least some portion of your money. And over time, as you learn more, you'll feel more and more confident to invest more and more and try out also different approaches and also build up your rule sets, which will be important for you to make sure that all the check and balances are there, that you don't fall back into the emotional aspects of investing, but keep it rational in the future. So, thanks a lot for joining me today. I look forward to see you in the next video, and especially I look forward to see you winning financially.